Hi guys, thanks for tuning in to another episode of Nuggets News. Today I've got a special guest, a friend of mine, David Hoffman. He's part of the, Bankless movement. These guys have got a fantastic podcast you've probably seen with Ryan Sean Adams. He's got a newsletter as well. So look, two must follows. I'll put all the links down below. But David, I thought today would be cool just to go over DeFi Yield Farming. It is turning into a little bit of a bubble. There's parts that I just love and think are going to continue to grow, and then there's some exit scams and these clones, and it reminds me of the 2017 Bitcoin fork. So yeah, thanks for joining us.
Oh, absolutely. Always happy to talk about this subject. It always changes every single hour, it seems. And so there's a never ending demand and stream of content that needs to be made. So absolutely happy to talk about it.
It is crazy, and we've been expanding our team, and one of the kind of jobs is to try and keep in front of all the news, which is almost impossible. And I said to them yesterday, look, we should start trying to just do a little post, even if it's just a paragraph about yams, because so often it can be out of date within 24 hours. And literally now I've just posted about based, and all of a sudden that's the hottest coin, and it is just nuts
Right.
how this is happening. That kind of worries me, because when you think about the depths of crypto winter, when it was like embarrassing to talk about altcoins, and now we're at the complete opposite. So yeah, maybe we'll rewind a little bit further for those that haven't followed you. So what was your sort of backstory and how you got into ETH?
Yeah. So the further back you go in my history, the further and more it becomes less and less relevant about crypto. Right.
Yeah.
And so I graduated with a degree in psychology. I mean, at the end of the day, you can kind of connect anything to cryptocurrency because it's so like multidisciplinary. But
Yes.
really, I was going into the health sciences world. I kind of just fell into the rabbit hole as we all do, and I wasn't really any unique individual. I thought I was behind the curve. I thought I had to be a coder. I thought I had to like understand distributed systems. I always kind of felt like I was going to be at the fringes. But at the end of the day, it didn't really matter because this world captivated me. And so I did the one thing that I knew how to do, which was learn and write. And it turns out those two skills have really worked out well in this space. If you can learn and if you can produce content, not just write, but produce content, then you can make things happen in this space. And I kind of just took those and ran with it. Started writing more. People read it more, and that I turned that into just my own kind of brand where I just write a bunch. Then turn that into a podcast, then turn that into two podcasts, and now I'm a very active contributor to the Bankless newsletter. And then it kind of just has gone from there. And so now I'm just this content producer, thinker in Ethereum who is a degenerate tweeter and a degenerate writer. And it turns out that's the thing you can do in this space.
Absolutely. I mean, I already had a long list of talking points, but I had no idea that you were going down the health science route. And like, I love psychology. So do you? I don't think you do get into the trading side of things too much, do you?
Not really. I'm not much of a trader. No.
That's interesting, because normally that is the hardest thing to conquer, your psychology and all that. So I reckon you'd be good at it if you did get into it. But
Yeah. I
yeah,
do claim that I actually did conquer the psychology part of trading because I very quickly realized that I was a shitty trader and my psychology, my own personal psychology, my own personal psyche was not fit to be a trader. And so I think I won that trading game by opting out of it. Yeah.
oh, absolutely. And I think that's important, because for a lot of people, it's the right decision. And some people lose their whole stack and they like, oh, I wish I had just been dollar cost averaging into Bitcoin and ETH this whole time. I'd be so much further in front. So it's a good decision to make if you realize that you're not a good trader or you don't have time as well, because it is definitely glorified and it takes years to get good at. So yeah. In terms of health science, so I don't know if you know that I'm a pharmacist, and I sort of went down that route and worked for 5 6 years, got a bit disenfranchised because I really wanted to help people. And I think there's a whole rabbit hole that we can basically 90% of scripts that we dispense we could get rid of if people ate really healthy and had a low stress lifestyle and looked after
Yep.
themselves, and people weren't interested in hearing that at all. So I was kind of sick of beating my head up against a wall. But what was your sort of journey into health science, and what were you looking at?
Yeah, no, that I kind of ran into the same wall that you just described. So I graduated with a degree in psychology, really wanting to become a clinical psychologist, really focused on like the way the understanding self-esteem, understanding self-actualization, learning to be a better person without having to deal with insecurities. And that's kind
Mm,
of where it started. And then I got really into nutrition. And trying to get into the paleo world and
yes.
like removing processed food and importantly understanding the connection between processed food and psychology, because if you eat junk, that junk ends up in your brain, like not figuratively, like literally, like junk ends up in your brain and it impacts the way that you think, right? And so that became relevant. So then it was like this hybrid psychology nutrition fascination. But then also I'm perpetually interested in movement, kinesiology, and exercise. And there's no way to have like good mood without having exercise. And so I became a personal trainer for a while. And then I moved into being a physical therapy assistant. And so it turned into this trifecta: psychology, nutrition, movement based like interest that I had. And I got just blocked by being able to actually express that desire as a career, because there is no like place for psychology, nutrition, and physical therapy or movement to actually like manifest, right? There's not a career around that. The closest thing I found was a physical therapist who is mostly centered in the movement realm, but have the expertise to talk about nutrition. And then also when you're meeting with someone for 1 to 2 hours a week for, anywhere between 2 and 6 months, you actually start to become literally their therapist, right? Like, because pain in your body also manifests as pain in the brain. And so you kind of need to be a mental a therapist to be a physical therapist. And so that was kind of the ideal. And that in my life, that was 2017 for me, right? And then I was about to go down the physical therapy route in the middle of 2017. I was looking at this mountain of debt coming my way from going into grad school. And so I'm thinking about how do I pay for this? I need passive income. And I start learning about like mining Ethereum. And that's where I get my passive income to pay for physical therapy school. And then I continue down the passive income Ethereum route. And then I just did a hard fork, if you will, into Ethereum and never really looked back.
It's so interesting. I had no idea where the conversation was going to go down this path. So I studied human movement for the first year out of school because I wasn't really sure what I wanted to do, and then I found that to be a little bit too sort of teachery, which I didn't really love. And then I was working in a pharmacy, and that's when I made the switch to move to a different uni and study that. But a lot of what you said there's not the sort of big pharma make it really hard to go nutrition and make that a career, and there's no money in getting people off medications. Like that's, you're not going to get sponsored by the local Apple company sort of thing to get people healthy. And it's the same, I think, as you said in psychology. And people think that sounds a little bit airy-fairy when you say you are what you eat, but it's almost like if people have too much, sugar, or you go on a race, you do a race and your muscles get lactic acid and sore. If you're constantly pumping sugar into your brain, it's the wrong food. And there's all this sort of research that's only just coming out now about inflammation and mood. One of the favorite episodes we've done on the channel was with a diabetic surgeon who's actually a friend of mine, and he was cutting off the limbs of people that have got diabetes so bad to the point where, you've got to cut off their fingers and toes and they're going blind and all that sort of thing. And he got to the point of bumping up against big food in hospitals, and his patients would go in and he'd check on them, and they were getting fed ice cream and orange juice and sugar, and he's like, we've got to get these people off all this stuff. And he basically lost his medical license, and the big food companies sort of sued him, and he kind of won this battle, and now he's sort of trying to push back and just, you probably know this whole story about the food pyramid, and you've got to eat all these, 5 lots of bread a day and all this dairy, and it was never like that at all. For thousands of years, people were eating plants, grains, meat, and that kind of thing.
Yeah, no, absolutely. It's one of the big conspiracy theories I have is like big food is just out to make people sick, to make big pharma a bunch of money, right? Like they're just in this interlocking relationship. Obviously, there isn't any puppeteer that's managing this, but like the incentives are all there, right?
And that's the thing that I think people realize. Like some people, like the David Ikes of the world, believe that this is all controlled by certain people. But what I found was there's just layers. You talk to the pharmacy rep and they're just a nice lady in their 40s trying to do their job for their family. And there's the person above them, and the person above them is trying to make their money and work their way up. And a lot of the time they're not even aware of this sort of alt education or these theories, and everything in the textbooks. It's just sort of so integrated, ingrained into the system that it's really hard to change. But over time, we see throughout history, these things change. It just takes a generation or two, like smoking, and we'll probably look back on big sugar like we do with big tobacco.
Yeah, hopefully. That's that's the future that I envision. Absolutely.
Awesome. Well, I'm glad we got that out of the way, but let's keep going with the ETH thread. So a steep learning curve for you, or was it like, had you looked into Bitcoin? Did you understand that side of thing, or was it really learning about just ETH through the mining and then Bitcoin came later? Or?
Yeah, actually. So I'm one of the very rare individuals that came into the cryptocurrency space directly into Ethereum. And I skipped right past the whole Bitcoin phenomenon. And that ended up actually costing me, I would say, in comprehension and understanding. And I do have to give a lot of credit to the co-host of my first podcast, POV Crypto, Christian, who is a big Bitcoiner, who, well, we kind of both got into crypto around the same time, both like class of 2017. A little bit too late in 2017. He got into Bitcoin. I got into Ethereum.
Yeah.
And then we started this podcast, POV Crypto, Point of View Crypto, because these communities are very tribal, right? Like we have different perceptions, we have different values. And it's especially on Twitter, we can't figure out what the commonality is between these communities. So we started this podcast to like discuss these things. And Christian and I were very fortunate to have been like college friends, right? So we're not strangers on the internet yelling at each other. We are like friends with like, you know, a relationship history, and we can be snippy at each other and mean the best, right? And so when it comes to understanding the differences between these two things, that is a really advantageous like relationship to have, because you can communicate, just simply you can communicate better. And so I credit a lot of my understanding about the importance and nuances of Bitcoin and how Bitcoiners perceive Bitcoin to that podcast with Christian, right? And so, and this is kind of where I think I'm a little bit unique in the Ethereum world, is that like I appreciate Bitcoin much more than the average Ethereum person, because of this perspective that I have.
Yeah, so my story is a little bit different. So I found Bitcoin in 2012 and just sort of casually read about it for all those years until probably 2015. I heard about the Ethereum like white paper and the project, and up until then, I'd sort of lost a few bets on like Aurora coin and a few altcoin pumps in 2014. So
I remember that one. Yeah,
sort of like a Maximus. And then I thought, you know what? There's so many people that are saying no. Take a second look at Ethereum. Went down the rabbit hole, and sure enough, it was like, wow, okay, there's something here. But yes, that is very obvious, the divide in the community, and it's almost like you've got to pick one or the other. Whereas I've always thought that one is sort of like a sound money digital gold play, and the other one is more of a tech play in terms of everything that it can do, the Swiss Army knife. But more recently, that the ETH BTC ratio on the charts, I think that's almost like a direct correlation to the emotion and anger on Twitter.
Yes.
And like the wrapped Bitcoin, now that we can have wrapped Bitcoin on Ethereum, that's sort of brought some people over. Whereas recently the scaling debate, so fees are climbing on Ethereum and fees are getting high on Bitcoin again. But to me, I've sort of been trying to get out there and find guests like, who can I have an honest conversation with this about? And it's very few people, I think, can speak honestly and unbiasedly about both coins. And yesterday, you know, Samsung Mao was like calling me a moron on Twitter and posting, you know, and liking the trolls' comments and stuff. And you're thinking, this is sort of like the CSO or whatever he is of Blockstream. This is the big company that is the hope to scale Bitcoin. And I just feel like there's no leaders, there's not enough Andreas Antonopoulos or Eric Voorhees, and there's too many of these maximalists that have got huge followings that are really toxic. And look, maybe I spend too much time on Twitter, but from the outside looking in, when you compare it to these other communities that are, you know, Cardano, they want as many people liking ADA. And I know the Ethereum, there's a lot of maxis as well, and they want everyone in their community. But compared to that, I just think that Bitcoin has somewhat wall gardened itself in that regard. I don't know. What are your thoughts on all of that?
Yeah, so one of the articles that I've written that I'm particularly proud of is called the Bankless Nation. And it's really a metaphor for these digital nations, Bitcoin and Ethereum, as nations, right? These aren't cryptocurrencies. These are not blockchains. Cryptocurrency and blockchain are a part of these things. They're a component of these things. But really, when you get down to it, they are nations, right? And before these digital nations, there was the physical nation state, like the nation states that we know today, USA, Australia, like any other nation state. But before those nation states, there were even earlier versions of nations, and we call those religions, right? And what we're really talking about are organizational schemes. And so the tribalism from Bitcoiners or Ethereans largely come out of this ideological perception as to how we should organize around these systems, right? Around these crypto, economic, blockchain, whatever platforms. And so, and you just recently listed some people that you thought were better representations of the Bitcoin nation than others, perhaps like Eric Voorhees and Andreas Antonopoulos. I would call them Bitcoiners. They focus on Bitcoin. They like Bitcoin. They identify with Bitcoin. So I call them Bitcoiners. And then there's a different cohort of Bitcoiners that I would call Bitcoin maxis, Bitcoin maximalists. And like, this is kind of like a concentric circle, right? And this is where Bitcoin is more of a religion than it is a nation state, because it promotes this certain ideology, it promotes this certain belief, and then it also promotes heresy in other beliefs, right? And a lot of Bitcoin maximalists fall into this trap where there can only be Bitcoin, the one true coin to rule them all. Anything else that isn't designed as Bitcoin is like a fraud and scam. And I would classify these people. I'm going to go ahead and name names because I think it's important to actually name names. It's like Dan Held, Pierre Richard, like these types of people are Bitcoin maximalists. They believe in the one true coin. And I've had both Pierre and Dan Held on my podcast, POV Crypto. So I've talked to these people and learned how they think. And Dan Held, the Dan Held interview was particularly interesting, where I asked him the questions like, okay, Dan, if it wasn't Bitcoin, like what are the prerequisites of a blockchain cryptocurrency platform? What would that need to look like in order for you to like adopt it as like an alternative non-Bitcoin platform, but that is like a different, like it's not Bitcoin, but something else. Like what does this something else need to be in order for you to like accept it? And then he started rattling off some characteristics. And those characteristics were, it needs to be proof of work. It needs to have like a fair start, fair founder, like no VC pre-mine. It needs to have a hard cap. And then he just listed off these things. It needs to have like small blocks. And then he had, at the end of it, he had just listed off the things that are Bitcoin, right? And so he just like recircled away to go back to Bitcoin. It's like, the thing is like, you can, there are a certain cohort of people that can only think in Bitcoin terms, right? And a large part of Bitcoin maximalists view the rest of the world from the Bitcoin like planet, right? And if you see a lot of this thinking, you can see it's plain in plain sight as soon as you can identify it. It's like the geocentric version of the universe, where once upon a time, astronomers were standing on planet Earth and they saw like everything else rotating around planet Earth. When it turns out everything else was rotating around the sun, right? And I view a lot of Bitcoin maximalists in the same vein, where like they think that Bitcoin is the one true coin to rule them all. Everything else rotates around Bitcoin, and that's just the way that it's going to be. And I just don't think that's realistic, especially in a decentralized industry. There's not going to be one single like central platform to rule them all, right? Like it's antithetical.
Yeah. So I'm really looking forward to having Dan Held on soon myself, and he's one of those people where they start to sort of get angry on Twitter, and I always try and treat them with respect and say, let's have a mature debate on a podcast rather than trying to rip each other's heads off. And I've been lucky to find Sam, who's like an XRP guru, who we have honest discussions. And we had, even recently our debate, I could tell that he was starting to come around to DeFi and saying, oh, you know what, like this stuff is really gaining traction, whereas XRP's maybe not. So it's interesting to have those honest debates. But in terms of Bitcoin and the scaling, and what I was trying to converse with Samson about was really, I think that the Lightning Network was it 2018 or 2019 that had the huge growth, and then it sort of stalled, and it's kind of almost been going backwards in terms of the node count and the channel capacity, whereas ETH has had these almost a dozen, I'd say, different scaling solutions now, and there's a couple of teams working on each variant. So I'd say we've probably got 24 or more of these teams that are integrating, and we've got optimistic roll-ups on Synthetics, Loopring Pay, all these teams in the Reddit scaling bake-off. So it's honestly just a matter of time. And hopefully within the next 12 months, a lot of the best projects can integrate layer 1 or 2, and we're not paying $20 gas. Have you've seen all this firsthand, I'm sure?
Yeah. So I've actually participated in a DApp, quote unquote, that is on layer 2, and that's the Diversify Exchange.
Yeah.
And that uses ZK Snark technology. It's cryptographic technology that's way beyond me. But the important points are that it uses the same level of assurances that the Ethereum L1 blockchain can provide, but it does it in an L2 way, right? And so the way I describe this is that the Ethereum blockchain is running, and then the Diversify, the exchange, has this ferry that goes back and forth between the Diversify exchange and the Ethereum L1 blockchain every 30 minutes, right? And so You hop on board to the ferry, you get over into Diversify, and then it's just like Coinbase, right? It's just like there's no fees to exchange. There's no gas fees. You don't pay gas. Everything happens instantly. There's an order book that everyone is used to. Everything is more or less the exact same way that you'd expect from Coinbase or Binance. The only difference is that there isn't a fallible server, right? There is a server, but the server pays attention to the rules of the Ethereum L1 blockchain, right? And so if the server goes down, you exit from the L2 using the ferry. That the ferry is actually supported by Ethereum, the ferry metaphor, but like the server doesn't itself actually matter. It just hosts the transactions. If it fails, you just leave. And so you use the server for the scale, but you use the L1 blockchain for the assurances that we're all here for in this future decentralized crypto economic world, right? And that's just Diversify, right? So there's Loopring Pay, as you mentioned, which is like a Venmo type app, which I'm super bullish on. And there's just a number of these different, like Synthetics, as you said, is another platform that I don't really think would be all that troubled by being one ferry ride away from Ethereum, right? Like, sure, people on Diversify, if they want to get to Synthetics, that takes some time to get there. But like, as for creating their own ecosystem and their own like network and their own liquidity, being a ferry ride away from Ethereum is not that far. And people who are dedicated to this world, dedicated to this ecosystem, will take that ferry ride. I mean, I'm using the ferry metaphor because I'm in Seattle and we take ferries all the time. But like, they're fantastic.
We do have a ferry down in Tasmania to go to Bruny Island. But I think another one that's surprised me, Amisi Go, a lot of people thought that was dead because all this other ZK research kind of surpassed Plasma research at one point. And now they've launched. Bitfinex said, yeah, we're using this Tether integration on day one. I'm really surprised that we haven't seen, FTX and Binance and everyone say, okay, well, let's all use this and get Tether fees down to zero and instant transactions and free up the chain. So I hope that catches on soon as well.
Yeah, I was also one of those people that thought that Omisa Go had just kind of drifted off. So very happy to see one of the crazy like 2017 ICOs that received a lot of flack for being an ICO ultimately come to execute 3+ years later, right? That's pretty cool. Hopefully that's not the last one. That's not the last one. At the end of the day, though, when we go on to the ETH gas station website and we look at the ETH gas guzzlers leaderboard, we always see Tether as number one. But it's important to note that like
I might bring Tether, that up while you're talking as well. For people
go for it. Do it.
Yeah.
It's important to note that Tether, the company isn't Tether. First off, it's Bitfinex, and they issue Tether, but no one single person is paying that gas. That's not one institution, not one team that's paying for all that gas. When you go on to Uniswap and you purchase Tether, or when you send Tether from wallet A to wallet B, you're using gas that ends up in this metric that you're showing here on the screen, right? So there's not one person that is spending $2.4 million in the last 30 days. That's not coming out of the funds of one person. That's many, many, many individuals. And if you go onto Etherscan and find the Tether contract, you'll find that there's probably like over 100,000 wallets that use Tether. That is the $2.4 million spread over like 100,000 different wallets, right? So it's not one team that's spending that gas. That's this one application that has incentivized 100,000 users to spend gas, right? So it's much more distributed than this like leaderboard would suggest it to be. Same thing with Uniswap, right? Like the Uniswap team isn't spending $2.7 million every 30 days on gas. It's people using it, right? And that's a very important differentiator.
And I think it's such a fine line. Once it's a little bit like how people think of the Bitcoin mempool getting full. It's such a fine line as well with these scams. If we could get rid of them, it might only be a 5 or 10% difference, but that can be enough to really start, that compounds, and all of a sudden things might be chugging along a lot better. But it is really frustrating. I know I was trying to buy some based today because everyone's talking about based, and this is like super highly speculative, but after watching what Wi-Fi and then Yams did, I thought, you know what, like I'm just going to throw an ETH at this because it's either going to do 10x or zero.
This whole Yam /based / liquidity mining phenomenon is incredibly interesting. With specifically Yams and also with based, It's starting to turn into liquidity mining for liquidity mining's sake. Like it's yield farming just to yield farm,
Oh
right?
yeah.
And so we're starting to get into territory that makes me a little bit uncomfortable. At the end of the day, however, so yams, let's take yams for example, and base is very similar to this. Yams is a collection of a number of different applications, mechanisms, reorganized and reintegrated into a different organization that is something new, right? And so yams took the Ampleforth rebasing mechanism, it took the compound governance module, it took the YFI liquidity mining distribution schedule, and it converged all those things into something new, which is yams, right?
Yeah.
And so those three things, those three new mechanisms are reorganized and combined into something new. And so while I can criticize yams for being something that's kind of liquidity mining for liquidity mining's sake, it's also this brand new paradigm, this brand new construction of various crypto economic mechanisms to create real value. At the end of the day, it's not thin air, it's not hot air, it's not just emptiness. There's real value going on here, right? And so the whole prospect of yams is that it uses the rebase mechanism to add to a treasury, and that treasury has non-subjective value. It's objectively valuable because there's dollars at the end of it, either synthetic dollars or real dollars. Both. There's Tether, USDC, DAI, all these stable coins that are tried and true are created into a treasury via the YAM system. And so it's this hybrid like speculative liquidity mining system that is also very much grounded in reality by having a US dollar reserve. And so it kind of just but via this construction, it memes itself into existence, into being this real thing. And based what you're showing on your screen, it's largely a very similar, comparable protocol.
Yeah. I think maybe, again, just to take a step back for everyone at home, there's kind of three sort of levels here for people to understand, to get their head around what DeFi and then yield farming is. So I guess the simplest one that everyone understands is there's stable coins, and then there was a bit of a demand for, well, previously there was always demand on exchanges for when you want to margin trade and borrow coins, and you could lend out your coins and earn a bit of a reward. That's basically just what DeFi is now in a decentralized model. And we had peer-to-peer sort of lending where I can choose to lend David some coins, or I can also choose to deposit some coins into a DEX, a decentralized exchange, and help them provide liquidity. And the theory is that if you're rewarding users with some fees, they're going to, make more than if they just had them on their ledger. But then these other protocols said, well, let's try and incentivize them and give away our governance token as well. So they're getting fees and then a governance token. And now people are saying, well, that's great. But then they can get that governance token, and there might be another place where people say that this governance token is the hottest thing now. I want to put this into another pool or liquidity pool, or help stake it, or whatever it is. And then they might get 2 or 3 tokens from synthetics for putting it in their pool. So there's these layer upon layers. And when you see this APY, this annualized yield of 100%, it's a little bit misleading because it's taking into account all the layers, and it's also taking into account the price of the token that might have just done a 10x. And so you see 100% or 1000%, and none of this stuff is sustainable. But if you've taken the time to learn how to use MetaMask and do liquidity staking, and you can do it securely from your hardware wallet, there's actually great money to be made at the moment, isn't there?
Yeah. And so this YAM phenomenon has been like the first liquidity mining phenomenon that I've actually taken part in. And like, it's really addicting, man. Like it's a ton of fun because like you literally see your assets grow, right? And that's where like yield farming actually came from. To your point where like, and you went through the progression pretty well. You start with like there's suppliers, and then there's borrowers, and then there's fees. And then then that's step one. That's phase one. And then phase two is, well, now there's a governance token that manages over the fees. And this is very similar to the concept of creating a business and then creating equity and shares of that business that control over the fees, right? That's basically the same model. And then we take that token and then we use that token as a part of another DeFi protocol, which is incentivizing the same thing, right? So there's a new governance protocol that governs over the governance tokens and uses those as liquidity. And then the governance token governs over the governance tokens.
Yes.
And this starts to sound pretty fucking crazy. Excuse my French. I don't know if we're allowed to swear on this podcast.
That's right.
But like, It starts to sound a little bit chaotic, and I totally get it. But at the end of the day, that's what finance is. It is layers. And inherently, DeFi is over collateralized layers, which is why at the end of the day, while there is smart contract risk, there is malicious actor risk, there is VC dumping on you risk. What there isn't risk of is people not being able to pay, right? Which is a really big risk because these things are over collateralized. So Bitcoiners will often criticize DeFi as just like reinstating the over financialization of the world that we're trying to pop. Like the '08 bubble, the '09 housing bubble was an over financialized world that popped, right? And we don't want to reinflate that bubble. But that's not what's going on in crypto because everything is over collateralized. We only run on over collateralized assets. And so while there are these layers upon layers upon layers, as you go up and down the layers, everything is over collateralized. And so there's always, I mean, the safety of the system is measured by the measure of over collateralization that each of these layers have.
Yeah, and I'm just trying to bring that up. I'm sure the stat will be here somewhere in terms of the over collateralization ratio. Might go to Oasis.
If you let me actually see if I can pull it up. It's on if it's on oasis.app, if you have a CDP open. And then the last I checked, we're talking about the MakerDAO system, right? So
Yeah.
the MakerDAO system is currently 284% over collateralized, right? And so there is 420 million DAI out there, and that has 284% more collateral backing it, right? And so I'm not very good at math at the top of my head, but if we multiply 420 million by 2.8, that gets us to $1.3 billion that is backing for $420 million. So, pretty substantial over collateralization.
Yeah, I'm sorry for people at home. I can't find that there, but basically, yeah, it's an over collateralization like Dave was talking about. But I just wanted to show people as well these. So this is pools.fyi. Nothing to do with Wi-Fi, but you can see all the different pools, and it's organized. Other than the sponsored one at the top here, it's organized by the return on equity that you can get. So you can see what's returning the highest at the moment. So things like Ampleforth, really popular. That's giving that 115%. But then we can see as well which ones are incentivized, which ones are stablecoin pools. And something like Synthetics is offering these higher rewards for people in a number of ways. The number of tokens you can get by contributing to certain pools. So in some instances, they're giving out like 4 tokens, or even a token that is a combination of other tokens. So you've got to take that over to another exchange or protocol and almost pull that apart because it's made up of different pieces. So this is where it's getting funky with all the layers. Do you want to add anything there or share your screen, David?
Let me see.
I'll stop sharing mine.
I don't have a screen ready to share. It is worth noting that the APR that's often quoted, and I think the website that you just shared quoted a 30-day ROI, which is much better than the typical APR that's quoted, because the APR that is quoted is generally calculated by like a 24-hour period and then extrapolated over a year.
Yeah.
And so that's how we get like a 1,000% like APR, which is ridiculous. It's just a raw, like a terribly incorrect metric to use, right? And so it's much better to use APR that's measured over 1 day or 7 days or 30 days, a much smaller time frame, because that is much more accurate. Because anything that has a 1,000-day APR is going to get arbitraged away. Like, it's not going to stay there. The reason why that 1,000% APR is there is because it's brand new. Right?
Absolutely.
And so that is an important distinction to make.
And something that's kind of frustrating for me when we were talking about, and there's always the scams and they're starting to pop back up now, it was kind of this rule of thumb where maybe you could get 8 to 10% over a year. And that was kind of the yearly, I guess, litmus test for what is a scam or not, because the BitConnects of the world promise 10% a month, 20% a month, or 5% a week. But now it's really blurred things because some of these DeFi protocols are offering that high. And for a beginner, they say, well, you told me that it's a scam if it's over this much. And that's a really fair way to think about things. But there's all these different layers and incentives, and you're taking smart contract risk, liquidity risk, price risk, hack risk. So there's a lot of things why you're getting that reward, and it's not quite that simple.
All right, so I actually do have a screen to share, and I'm going to share
awesome
this yam.zippo site. And so this is from the Yam token that got issued yesterday. So right now it is 8:30 my time, Pacific time, August 12th. And so this launched 1 day, 8 hours ago. And so we are 32 hours into this, right? YAM token is $12. It's got almost 600 million US dollars locked in it. And the way that this works, let me go to yam.finance. Yam.finance. And so the way that this works is that there are these 8 different farms, not including the middle one. I'll talk about the middle one in a second. But there's these 8 different farms, and each of these correlate to one of the very popular tokens on Ethereum, right? So and these all have very cute names, right? So the Maker Range, MKR for the Maker DApp protocol, SNX, the Spartan Grounds for the SNX token, Aave for the Len token, Compound for Comp, YFI for Yiffy, just plain old W, wrapped Ether, that's Ether just in a ERC20 token form, Ample, Marine, the Link Marines. And so what you would do is you would come and you would deposit your MKR, or if maybe you're not an MKR fan, you would deposit. Oh, I just doxed myself. I have 322 Link or as synthetics, and I'm staking it. I've deposited it into the contract, and that contract is paying me 6 yams. Now, in this particular instance, it's not actually doing anything, and so you're not you don't deposit your tokens into the contract, and then the contract goes and does something with it. The contract is really just trying to get you to prove that you're willing to lock up your value. And that's how it pays you the yams, right? And so for the 322 Link that I have, it's paid me 6 yams. I can click this harvest button. And then again, this is just going on the yield farming meme. That's why there's all these farming words that we're using here. So I will withdraw my synthetics, right? And so synthetics is right here, and it's giving me 12%, 12% of the pool for the SNX token, right? And so different depending on how much value is deposited into these various pools. Over time, it's actually equalized pretty well. Somebody has done a very good job balancing these out. Earlier today, these were all over the place, right? So earlier today, Link was at 8% and YFI was at like 12% and Aave was at like 16%. Someone's come and balanced these out pretty well. And that's kind of what yield farming is. That was kind of like what liquidity mining is trying to get that liquidity to be the best thing so that you can get the best return on yams, right? Because yams are worth $12. So the more yams you can get, the more you can sell for $12. And that's like the first step to the YAM protocol. That's like the first step of liquidity mining for yams, right?
So where it says you have to harvest every 3 hours, do you miss the rewards if you don't claim every 12-hour period? Is that right?
I don't think that's right, but I've been claiming my rewards faster than that, so I could be wrong. I haven't heard that. And again, it depends on every single protocol.
The other thing that's super interesting for me, so I did a write-up about this yesterday when it was $80, and my understanding was it's the same as Ample. So if people don't understand Ample is a stable coin that's meant to always target and rebalance $1 over time.
Slowly.
So instead of just having a tether that's pegged to $1, you have this kind of market cap, and as it grows, it rebalances each day. So if you've got $1,000 worth of Ample, you're always going to have $1,000 worth the next day. But if the token price, it's going to rebalance so that the total value of the token and the number of tokens always gives you $1,000 of value. That's right, isn't it?
No, actually, also not quite. And so the way that Ample works is that say you buy. Say the market cap of Ample is $100,000, and you own $1,000 of that.
Yes.
The token will mint itself or burn itself to make sure that the token itself is worth $1, but you will be minted more or have tokens burnt from your wallet accordingly. But your total value of what you own can go up and down, right? And so. And so the rebase is the thing that does this rebalancing. So say you own $1,000 and there's $100,000 market cap, and so you own 1%. You own 1/100th, right? And so then people go to Uniswap, people go to Binance, people go to wherever, and they purchase these Ampleforth tokens, and then the token goes up to $3. And so all of a sudden the market cap is now $300,000. You own $3,000. And then you still own 1% of the total supply.
Yes.
And then the rebase happens, and the rebase mints 3 times as many tokens into your wallet. And so it may be in the previous example, when you owned $1,000 out of the $100,000 market cap, you owned 1,000 tokens because each one was worth $1. Now you own 3,000 tokens, each one is worth $1, and now there's a $300,000 market cap. You still own 1%. Each token is still worth $1. Now, instead of having 1,000 of them, you own 3,000 of them.
Yes.
And so your percentage ownership over Ampleforth never changes, but the price will always change in order to try and keep itself at $1.
Absolutely. Good explanation. I did butcher that. Sorry, guys. One of the reasons I don't like Ample is because we've seen it swing from like $3, nearly $4, and then down to 50 cents. And it's sort of claiming that, well, over time, we're stable. But again, I just don't see the use case for the end user. If you and I want to denominate something in Aussie dollars or US dollars, that's not really going to swing more than 10 or 20% a year. You know, if we're in Argentina or Zimbabwe, it's a different story, but you'd probably use US dollars. So what do you see as the use case for an Ample?
Yeah, and so I've gotten some flack for this, for being optimistic about this mechanism, right? Because there does seem to be like, okay, so we have this mechanism, now what? Like, cool. Like, what do we do with this? The easiest mechanism that I can think of is that it's a great way to denominate debts in over time, right? And so no matter, like, imagine denominating a debt, like say you borrowed 1 Bitcoin from me in like 2013. Yeah. So you borrowed like $6 from me. And now I come back to you like, hey, will you pay me back that Bitcoin now? Well, now Bitcoin's at $13,000, $12,000, right? And so it's not the same. It's not the same thing. And so say you borrowed 1 Ample from me in 2013. Well, then you can just pay me 1 Ample back, and it will roughly be about $1. Maybe it's 70 cents, maybe it's $3, but it's not to the same discrepancy that Bitcoin has gone through. And so like maybe your next question is like, okay, well, why wouldn't we just denominate this in a stable coin, right? Why not USDC? Why not DAI? And the answer to that question is both USDC and DAI are M1 currencies, not M0 currencies. And Ampleforth is trying to position itself as an M0 currency. And so DAI and USDC is somebody else's liability. Somebody else must be solvent in order to credit you with that dollar that you are owed, right? Like the MakerDAO system must be solvent. The USDC Circle Bank must be solvent. Ampleforth is M0. It's an asset that is no one else's liability. So there's no solvency question. And that's one of the core fundamental things about blockchain assets, Bitcoin and Ethereum particularly. One of the main reasons why these assets are so special is because no one owes you anything if you own these things. They are valuable in their own right, very much like gold. Just owning the asset is valuable. And Ampleforth is the same thing. It's an asset that is no one else's liability. So it's an M0 trustless asset that is outside the purview of a nation state, which is why we like Bitcoin, which is why we like Ether. And Ampleforth is in that same realm. It's a pretty shitty stablecoin. It's not a good stablecoin. No one should be treating it as a stablecoin. But in terms of denominating debts over the long term, I see potential there.
Yeah, I mean, I do like gold and silver for that reason, because it's no one else's. But it's debt, but it's a little bit hard for a physical item to be completely trustless, like we've seen in the crypto world. If I wanted to denominate that debt in Amples and it's currently trading at $3, do I have to theoretically wait, or can I denominate that debt in that day? Do you know what I mean? Like, do I have to wait for the day that Amples is $1 itself? Or if I'm trying to denominate the debt with you and do a deal, it's not much good to me if it's 50 cents and then $4 and you say, oh, well, wait until it's $1 to use it.
Yeah, so this is going to, in order to answer that question, we'll probably need like more details as to how the loan is generated, right? So are we generating this loan on a peer-to-peer basis between you and me as a pen and paper agreement? Or are we doing it through a protocol like Compound, which does everything automated? If you agree to me that like, hey, here's like $5 worth of Ample, then we can agree to those terms, you and me specifically. But if we're doing it through a protocol, the protocol is only going to know the value of Ample. And so like it's only going to know that, hey, individual owes 5 Ample and individual B borrowed 5 Ample. And so it only cares about returning 5 Ample doesn't care about the purchasing power of Ample, doesn't care about the USD price of Ample. It just knows 5 Amples owed and 5 Ample needs to be paid.
Okay. I might get the team on because I do want to ask them about a few more of these questions. Anyway, that is the long way around to explain that it can only rebalance. Is it 5 or 10% every 24 hours in terms of Ample?
I think it's 10%. I should know this, but I don't. I think it's 10% every 24 hours. It gets closer. So it doesn't automatically just go right to $1. It tracks $1 over time. And so there's no way that Ampleforth can be like $1,000 because at $1,000, every 24 hours is going to change by $100. And it's going to move downwards.
And that's where if it's $3, it can only change 20%. So it goes 10%. So it goes down to $2.70. And then the next day it'll keep rebalancing. Right. That's what I thought was the same mechanism with YAMs. But yesterday it was $80. And I was sort of saying, I'd love to short this, but there's nowhere to trade it yet if you know it's going to rebalance. But then it went down to like $10 and it actually went 90%. So then to do that, it's got to print 10 times as many tokens like we were talking about to have that elastic supply and balance. And I don't think it was meant to do that because it flooded 10 times the supply or whatever it was to all these dexes or however it works under the hood. And that was apparently a bug. That's all right?
I don't think it was a bug. It's really up to the builders of these contracts that determine how aggressive the rebasing is, right? And so it sounds like the Ampleforth team wanted a not very aggressive rebasing mechanism. This 10% is pretty slow.
Yes.
Even if the Ampleforth token is at $100, it's going to take it more than, no one buys any more of it. It's going to take like way more than 10 days to get back to $1, right? Way more than 100 days, excuse me. And so with the YAM token, the developers who decided to set these parameters decided on a much more aggressive rebasing mechanism. At the end of the day, I think it's folly to rebase it straight to $1 because then you will just overshoot. And so it's safer to undershoot it and do it over time. But I think the developers thought it was appropriate to more aggressively target $1 faster. And I think that has to do with the fact that also what is unique about the YAM system is that in the rebasing mechanism, when YAMs are minted, 10% of the YAMs go to purchase an asset and add that asset to a treasury, which is governed by the YAM token holders. And that's the key differentiator between Ampleforth and YAMs. Ampleforth is trying to be an M0 currency. YAMs are trying to be a money because it will always peg itself to $1, similar to Ampleforth, but it also has a treasury back behind it. And so it's also kind of like a capital asset that has cash flows. And so it's both trying to be this hybrid M0 currency while also being a cash flow asset, right? And it's not so crazy that assets transcend both multiple categories. There are 3 categories: store values like gold, real estate, currency, and then there's cash flow assets like equities, real estate, bonds, and then there are transformable consumable assets like wheat, coffee, oil, energy, batteries, and some assets are multiple of these things, right?
Which I was going to get into next. We'll get into Ether next. But I just wanted to wrap that up by saying that I think one of the criticisms was that the Ample team had a big reserve of tokens, and maybe some of these clones and forks are trying to say, well, we're more community orientated with our treasury. And that's the value of, I guess, overall for these governance tokens. So when people say, well, what does comp do? Well, they were the sort of the first one that got everyone excited on that Sunday when it starts pumping. People say, well, it doesn't have a lot of utility at the moment, but if we all hold this token, we can vote to start paying ourselves the fees or make changes to the protocol. So this is just the game theory and experimentation playing out, isn't it?
Yeah, absolutely. And so I think a potential fair way to classify YAM is a non-VC version of Ample. So an Ample, but without the venture capital behind it, plus governance, plus a few extra like bells and whistles. And that doesn't make it an Ample. I want to be clear. It doesn't make it an Ampleforth competitor. It's something different. Like Ampleforth and YAMs are trying to fill different niches. Ampleforth is trying to be a trustless M0 currency. YAMs are not an M0 because they have a treasury behind them. It's the treasury that is the M0 to YAMs M1. And it's also and Ampleforth has in its values to be governance minimized. YAMs have governance formalized and baked in. right? These things are trying to be different. And these mechanisms that are shared, mainly the rebasing mechanism, but also YAMs share a governance and liquidity mining mechanism with both Compound and Yiffy. These mechanisms are shared, but the final construction of these things make them different, right? And so Ampleforth and YAMs are similar in that they rebase, but they fill totally different niches, right?
Absolutely.
And that's a very important distinction to understand.
Yeah, so I think we've been going for a fair while, but I do want to sort of wrap up and talk about Ether, because you and Ryan have done a lot of talk about ETH is money and this triple point asset. And it's something that I'd never heard that sort of terminology before, but something that I've been talking about on the channel is that ETH never really used to be like even spoken about that much in the very early days. It was just the Ethereum network and the world computer. And then when ICO craze came along, it saw a huge demand for ETH as the only money you could sort of do this with. That also played out to its detriment when everyone in EOS starts dumping $4 billion worth of ETH over the next 18 months. But now we've got this other component where, oh, you can get yield and ETH can be collateral for the synthetic system. You can get a loan. Now you can pay gas in of itself, which is becoming more and more important. But also we're going to lock up a lot of ETH in ETH 2.0. So do you want to talk about all those different features and how it was only 6 months ago, wasn't it, when people were saying ETH's not money, and all of a sudden it's like, well, yes, it is.
Yeah. Yeah. And so Ether is a triple point asset. The triple point asset is a reference to the triple point between solids, liquids, and gases, right?
Yes.
For every substance there is, water, like whatever, carbon, whatever, there is a triple point between where that substance is a liquid and it's a gas and it is a solid, right? And if you balance pressure and temperature, you can find that triple point. And if you go to YouTube, you can just search triple point of water, and you'll find YouTube videos of people that have found this perfect equilibrium between pressure and temperature, where water is ice, it's water, and it's a vapor all at the same time. And so I wrote this article that alluded to that same mechanism, right? Where Ether is a triple point asset because there are 3 asset classes, asset superclasses that I just alluded to: store value, capital asset, consumable, transformable, right? So store value is like an M0, gold, real estate, things that hold their value over time, really hard to produce more of. Capital assets are things that produce cash flows for you. That's owning a company, owning a treasury, owning a T-bill. And then there's consumable, transformable assets, which are largely commodities, energy, coffee, wheat, oil, gas, things that when you use them, they're gone, right? And so Ether fits all of these categories, right? And so we have the ETH locked in DeFi, and that is ETH being used as a collateral, ETH being used as a store of value in these protocols. Yeah. Then we have Ether being staked to Ethereum in Ethereum 2.0, where you receive dividends based on your Ether, right? And so that is Ether as a capital asset because your Ether produces more of itself for the stakers. And then there's Ether as gas. And that is Ether. You need to spend Ether and then burn it in order to pay for transaction fees on the Ethereum network, which goes to the validators, right? And so yes. Ether is both of these things, or excuse me, all 3 of these things all at once. And so that metaphor is kind of summed up in the Ether as the triple point asset thesis.
And I just wanted to share this. So this is something where I just sort of did the basic models and calculations. And this is modeling ETH as a stock to flow once we're fully integrated with the ETH 2.0. So this does assume that there's going to be a fair majority of people staking, and that's not unreasonable. I mean, we have seen in Tezos and synthetics, 80 or 90% of people stake. But even if we don't get that, I still think the people that don't stake are going to be locking up in DeFi or somewhere else. So I think it's safe to assume that most ETH is going to be locked up or being utilized in some way. And you can see that gives us a stock to flow of 58.5, which is right up there with gold. And we can extrapolate that out and saying all else being equal, that would give, ETH a market cap of over $1 trillion. Now, obviously there's a lot of different things that make Bitcoin valuable and ETH different. So this isn't just the only model you should use to say what price is, but this doesn't take into account ETH 1559, the improvement proposal that says we're going to start burning base fees, and people can pay a little bit more in fees still to get a priority for the miners or the stakers at that point to process their transaction. But all these sort of fees that we're seeing at the moment, huge gas fees, they're going to start to be burnt. So we might have this Vitalik spoke about this with me yesterday when we were recording the documentary. We might be aiming for, say, round numbers, let's say there's 100 million ETH, when we might issue 500,000 a year. So inflation is 0.5. But if we're having all these people use the network, we might have 1 or 2% of ETH being burnt a year. So it's actually becoming deflationary. And that would actually give it an even higher stock to flow. It would be far more scarce than Bitcoin.
Yeah. People often call Bitcoin as like a deflationary asset, but it's actually incorrect. It's just a dis-inflationary asset. It doesn't inflate. It doesn't deflate. The deflation comes from the fact that like supply is static and then demand is growing, right? And so as a result, you get deflation because the asset price increases in order to answer to that equilibrium. But the supply of the asset is actually stable. With Ethereum and staking, which really reduces the issuance, and then as you said, EIP 1559, which reduces issuance even more, and then perhaps even negative. If it does indeed get to that negative point, we will have an actually disinflationary asset. It's not passively disinflationary, it's actively deflationary because supply is actually going down, right?
Yes.
And so people that might be interested in buying Ether today, based on this thesis, are speculating that the supply of Ether over time will actually reduce. And so you will actually own more of the Ethereum network by purchasing Ether today than you will in 5, 10, 20 years, because all of these transaction fees, which are immense right now, super high, they're not going to be that way forever. Hopefully, maybe they will be, I don't know, but they are going to be there. And those transaction fees will result in the burning of Ether, which at the very least will lower the interest rate even below the 1 to 1.5% issuance from the ETH2 spec to even lower than that, and then even perhaps going negative. We don't know because these numbers aren't. These are kind of just hypothetical numbers, but at the end of the day, we do. There are very realistic scenarios where Ether issuance actually goes negative as a result of the demand for using Ether as gas on Ethereum.
And so just if you think about all the macro stuff we talk about on the channel, guys, when you start to say, well, there's going to be a zero or negative interest rate environment, and now you can stake your ETH, the yield that they're talking about on that is 5% or even higher, depending on how many people do it. That's going to be really attractive.
5% denominated in Ether, not denominated in USD, denominated in Ether, which is an important distinction.
Yes, and then, so you have the capital growth. What's everyone investing in at the moment? The FANG stocks, technology, decentralization, working from home. Just about every angle you look at this, you can make a bull thesis. And I definitely think when ETH was trading at $100, and I was saying it's radically undervalued, the world has not realized that yet. So I think there's so much more of this story that can play out. And also, I hate to rip on Bitcoin because I still do love Bitcoin. I think the digital gold narrative is very important. But if it doesn't scale, if people don't continue to implement SegWit, if we don't get any other upgrades, if the Lightning Network doesn't catch on, I just wonder what's going to happen there if fees are super high and Ethereum starts to scale as well. That can, I think, make Bitcoin more unpopular with some people. Maybe it doesn't. Maybe it scales on Ethereum with the wrapped versions. But any final thoughts to wrap up everything, Dave? That's been absolutely brilliant.
Yeah. It is fair to ask the question, like, what happens if Bitcoin doesn't scale? And I think to some degree, we've seen the answer to that question in this mass exodus of Bitcoin assets being migrated to Ethereum via these different wrappers. There's WBTC from BitGo, there's TBTC that's coming, and then there's RenBTC, which is the most successful one.
Yeah.
And I think if we continue to see a lack of innovation from Bitcoin scaling, then we will continue to see an exodus of Bitcoin from the Bitcoin blockchain onto Ethereum blockchain in this synthetic form. However, in order to be fair, Ethereum needs to scale too.
Yes.
Ethereum has its own scaling issues, and like as an Ethereum person, I identify as somebody who embodies the Ethereum values. I understand that like if Ethereum doesn't fail, we might fall victim to another version of what Ethereum is to Bitcoin, but to Ethereum, and we might migrate our economic activity onto that chain too. And so like let's not pretend like Ethereum has this like golden pathway into success. Like it has troubled roads ahead. However, the main difference is that Ethereum actually has options, and Bitcoin doesn't really seem to have options. And so
No.
that's kind of what remains me to what keeps me bullish about Ethereum.
Yeah, and I think the maximist sort of argument as well. If you said to Dan Held and these maxis, if Bitcoin fees are $50 or $100 again, like December 2017, and ETH gas fees are $30, you're going to tell a beginner on an exchange that it's not good to use Litecoin and send coins to wherever it needs to be for 1 cent. I mean, it just doesn't make any sense, pardon the pun. And that's where I think that these other currencies, cryptocurrencies, are still going to play a big role to some degree.
Absolutely.
Awesome. Well, guys, I'll put the links to follow David and the podcast and their newsletters and everything. It's fantastic. And we might have to catch up again in future, mate. That's been great.
Oh, absolutely. This is fantastic. Thanks, Alex.
Cool. Thanks, guys.